Back to Your Personal Bank Show with President and founder of Secure Estate Management, Ferenc Toth.
Welcome back. All right, we're here to talk about your personal bank. We're talking about money. We're talking about how to have access to more dollars, how to capture interest instead of pay interest, and create tax-favored income all in one fell swoop. So as I've been explaining, as far as how your personal bank idea works in terms of taking control of your money and having access to those funds to use short-term needs when you have emergencies, life happens, right? Or you see opportunities. In fact, and then also build it for long-term, not lose the compounding effect of the money. You can operate it that way where the compounding for long-term, tax-favored retirement income can be created all at the same time. It's really an awesome combination and a powerful tool, as we put it, if you combine it, both sides of it, and use it effectively. So the bottom line is this. Really what we're trying to accomplish here is this. One of the main keys, I've shared a couple of key financial concepts for financial success, okay? And one of them I've been talking about for quite some time now is thinking like a banker versus an investor. Protect the downside. Have some risk-adverse strategies with your money. There's another key financial concept in terms of financial success. We all know it, but I'm going to define it, and you're going to understand it better, hopefully. And it's this. Access to capital is huge in terms of key for financial success and reducing stress. Here's what I mean. Whether you're an entrepreneur and you work with money with your business, or you're an individual household has a budget, if you will. It operates like a business. You have income, you have expenses, just like a business. You want to think of it in those terms when you're balancing the checkbook, paying the bills, whatever needs to be done. Having access to capital is the key to taking advantage of opportunities when they present themselves. We've all had that happen. We're going along in our daily lives. Something happens. We see an opportunity. We just know in our bones that this is a good opportunity. This is something that you'd like to be a part of, that if you could put some money into it, you're convinced it's going to be something that's going to turn into something great down the road. And if you've just suffered some type of financial setback or your funds are limited, that can be extremely frustrating. And in fact, businesses often fail because they're unable to take advantage of those opportunities. Things when they come up, can they take advantage of that opportunity or not and move to the next level and succeed with that business? When you're thinking about yourself individually or household or whatever, it's the same thing as far as being successful long-term and creating that retirement income so that you can enjoy the golden years and such and take care of your family. Opportunities present themselves. You have to have money available to do it. And when you don't, or if you do have the money and there's significant penalties, tax consequences, various things like that to access those funds, that can discourage or eliminate that opportunity because the cost of getting the money is too great to try to take advantage of the opportunity that presented itself. The flip side of the coin is when bad stuff happens. So that's when good things happen. What about the bad stuff? I mentioned it earlier. Economic downturns, job losses, income losses, medical issues, various things, emergencies. Those things happen in life. And we have needs for money at those times in our life too. That's why, financial advisors for the ages say have, 6 months, maybe a year of reserves, cash reserves set aside for those emergencies. So in case the roof leaks or the car breaks down or whatever, you can handle it. You can take care of it. It's sad. There's all types of studies out there where the average American, if they lost a paycheck or two, they would be in financial dire straits. That's no secret. Most people know that. Having that cushion, having that reserve is a key to financial reduction of stress. My wife, I shared this before, but we've been successful in our lives at times, and we've had times in our lives where things weren't going so well. We personally invested in a lot of real estate in Phoenix, and starting in 2001, and we all know what happened in 2008, 2009. It was not fun. Also had a business. I've owned several businesses, been very successful with some, have had some situations, of course, over the years with others. And the reality is, my wife said something that was so interesting. She goes, money doesn't make you happy. She's right. But what it does do is it sure gets rid of a lot of stress. So when you're dealing with those emergencies of life, but money's not a problem, it's easier to handle those, or it's one less thing to deal with. I'll put it that way. Okay? Having access to funds is key. So your personal bank, where you have access to funds myriad different ways, we'll explain that further, how you can access funds here, is key. It's powerful to make sure you take advantage of those opportunities, or don't get hurt by those emergencies in life. Now, my challenge is this. When I say to people, you want to look at life insurance as a financial tool to grow cash and all these things for short and long-term purposes, I have people that will stop listening at that point, and they'll think, well, they view insurance as an expense, not as a financial tool that can become an asset that can grow cash over time. And they stop listening and they miss the whole point. This is not what we're talking about. And there's basically 3 different types. There's a fixed, there's an indexed, and leveraged options. Fixed is what it is. Sounds like it's consistent returns. It has guaranteed and insured type of returns. The steady Eddie, if you will, as I call it. And, these days, historically, these days 5-6%, depending on the company, is what they're paying. Historical averages have been in those ranges, 5.5 to 6.5, if you will. Index, of course, returns are based on the S&P 500. Most often, an index, typically for S&P. The nice part is, so those bad years, you don't lose, and so there's no downside market risk on the bad years. In most cases, most products, you can make a nice double-digit return in the good years, and don't lose in the bad years. What do they do? What's the trade-off? It's really quite simple. There's caps, and they cap the upside. Some do, some don't, or there's a fee. They either make their money through the fee, or they take a piece from the cap and apply it to the downside to protect the downside. The average on those kinds of things, 6.5, 7 over the last 20 years, depending on the company. That's pretty straightforward. And like I said, if you have questions on that, we can send you some information on that. Contact us at yourpersonalbank.com. Be happy to send you additional information to show you these numbers. Right now, I just don't have the time on the radio to delve into it. But if you want more information, we can send it. This is interesting for those that are familiar with and comfortable with leverage in their life and their business or those types of things. If you want to find out more information about how the leverage option works or any of the options, contact us at yourpersonalbank.com or toll free 866-515-6280. Be happy to chat with you and see if this is a good fit for you or not. We'll talk about one more piece at next segment. You're going to love it. Stay tuned.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com.